Hello everyone, this is a detailed video on financial decisions leverages. If you want a shorter version for revision, then please refer to this video. Now let us dive into the chapter. Starting with leverages. Leverage is basically the effect of changes in the final output due to some changes in the inputs. It is a small force to move something big in a simple terms. For example, if you have 1000 rupees and if you borrow 9000 rupees, now you have 10,000 rupees. Now you can buy something worth 10,000 rupees. So this small money is giving you a bigger impact. But if something go wrong, if you're not able to get a revenue out of this 10,000 rupees, then your risk is also high. 9,000, again you have to pay it back. Now, before coming to the leverages, you have to understand the risks present also. There are two types of risk. One is business risk and one is financial risk. Business risk is basically related to the operations. Whether my operating income will be profitable, how will my EBIT? That is the business risk. And coming to financial risk, it is the additional risk because of the debt. You got loan at a 10% interest, then this is your additional risk. This will directly be your financial risk. Now coming to leverages, which I told is the impact. Now, this leverage is calculated by change in y divided by y and change in x divided by x. That is, how much x is changing because of y. That is your leverage. That is called as leverage of y with x. So, there are three types of leverages. One is operating leverage, which is directly related to your business risk, which will be the leverage between sales and EBIT, which is basically the business risk. And second is your financial leverage. It is the leverage between EBIT and EPS. Basically, your business profit you have got. After that, because of the interest, how much is your final earnings per share is changing. That is your financial risk. And third is combined risk. It is combination of both of this. That's why it is a sales and it is EPS. Basically, the effect of sales on the final EPS is the combined leverage. Now, to understand or to calculate any of this leverage, you should understand this total chart. It's a very basic chart. Basically, it starts from sales. Sales minus variable cost will be your contribution. Now, contribution minus your fixed cost will be your EBIT or operating profit. Now, in this operating profit, if you subtract this interest, then it will be your profit before tax or earnings before tax. Now, from this, you subtract tax and then you get profit after tax. From this, if you have preference shareholders, then you have to give the preference dividend also. If you subtract that, then you get earnings available for the equity shareholders. Now, this divided by number of equity shares is equal to your earnings per share. This chart, if you are well aware of, if you have it by heart, then entire chapter is very easy for you. Now coming to operating leverages. This is basically how EBIT is changing because of the sale. So degree of operating leverage DOL is equal to percentage change in EBIT divided by percentage change in sales. Now how is EBIT calculated? It is basically sales minus variable cost minus fixed cost. This is per unit, so you multiply by quantity. Percentage change is basically changes divided by the actual variable, whichever you're taking. For example, actual variable. For example, if you want to calculate percentage change in quantity, then it is changes in quantity divided by quantity. It is that simple. Now, coming to percentage change in EBIT, it is changes in EBIT, I have put the formula here, and divided by EBIT. Same with sales. What we mean by sale is quantity only here. Sales is basically quantity into selling price. Now the selling price is external factor. So in this entire chapter, we will compare only quantity. Now percentage change in sales is changes in quantity divided by quantity, which is this formula. Now when you simplify this formula, you put this one vertically and this also vertically. You put divided by. Now to cancel out this division, you convert it to multiplication and just reverse it. Now you knock it off this changes in Q. Then you have Q into S minus V divided by Q into S minus V minus F. Quantity into sales minus variable cost is nothing but your contribution. And contribution minus your fixed cost is nothing but your EBIT. That is why DOL is equal to contribution divided by EBIT. What is this break-even analysis? Break-even analysis is the point where there is no profit and no loss. That is, total cost will be equal to your total revenue. Now, to calculate that in units, you will need fixed cost divided by contribution per unit. Let's take two cases, case 1, case 2. Now, in the first case, selling price is 40 and your selling price is 20 in the second case. You have variable cost of 12, 20 and 12. Now, your contribution will be 40 minus 20, which is 20, 20 minus 12, which is 8. Let us imagine this is for 1000 units. Then you have contribution total as 20,000 and 8,000. When you have fixed cost as 50,000 and 5,000, your EBIT will be 20 minus 15, 5, 8 minus 5, 3. Now, how to calculate BEP in units? Your total fixed cost is 15,000 and your contribution per unit is 20. Similarly, here also it is 5,000 and it is 8. Now your BEP will be 750 units. That means at 750 units, you don't have any profit or any loss. Now, how do we calculate operating leverage? As I said before, it is contribution divided by EBIT. Now, our contribution is 20,000 here and our EBIT is 5,000 here, which is equal to 4. Now, 4 times we are leveraged. That is the meaning of this operating leverage. Similarly, for this also, it is 8,000 divided by 3,000, which is 2.7. Now, let's come to another concept called margin of safety. Now, what is this margin of safety? It is nothing but a buffer. Let us see the formula first, then I will show you the concept behind it so you understand it better. Now, margin of safety is calculated as sales minus BEP sales divided by sales into 100. It might look weird, but let me give you an example so you understand better. Let us say your selling price is 100 and your variable cost is 60. Now, your contribution will be 40. Let's say your fixed cost is 4 lakh. Now, what is your break-even units? It is 4 lakh divided by 40, which is equal to 10,000 units. Till you sell 10,000 units, you don't have any profit or you don't have any sale or you don't have any loss. Now, let us say actually you're selling 13,000 units. This is your actual sales. Then 13,000 units minus this 10,000 units is your buffer, which means you can reduce your sale by 3,000 units and you will still not be facing any loss. That is the meaning of margin of safety. You can fall back up to 3,000 units. Now, when you calculate it in percentages, it is nothing but 13,000 minus 10,000 divided by 10,000, which is 3,000 by 10,000, which comes to around 23.08%. So, your sales can drop by 23% before you can incur any losses. Now, this MOS, since it is related to safety and degree of operating leverage is related to risk. Now, these both are opposites. That's why it is inversely proportional. Therefore, DOL is also calculated as 1 by MOS. Now, let's go to the next leverage, which is financial leverage. Financial leverage is calculated as EBIT divided by EBT. This we have seen in the first also. It is basically how much your EPS is changing when your EBIT is changing. It is as simple as that. Now, financial leverage is also called as trading on equity. Now, this is an important concept for the exams also. Why it is called as trading on equity? Now, when your earnings is more than your cost of debt, then you are in a favorable position. When your earnings is less than your cost of debt, then you are in an unfavorable position or unfavorable financial leverage. Now, when your fixed cost is more than your equity capital, then it means that you're trading on equity. Now, I will explain this with an example also. You are using other people's money, that is debt, to increase your return on your equity. That is why it is called as trading on equity. Now, let me explain it with an example. Let us say you have a business for which your total investment needed is 10 lakh. Now, in the case 1, let's say you are only funding everything. So, equity is equal to 10 lakh, which means there is no cost of debt. cost of debt is KD here. Cost of debt is 0. Now let's say you are earning 2 lakh. Now there is no interest, so your PAT will also be same as 2 lakh. Now what is your return on equity? You are earning 2 lakh on 10 lakh, which is equal to 20%. Now in the case 2, let's take the same situation. Investment needed is 10 lakh. So you give an equity of 5 lakh and you borrow debt of 5 lakh, and you are borrowing it at 10%. So cost of debt is equal to 10%. Now your EBIT, the performance is same, so 2 lakh. Now your interest will be 10% on 5 lakh, which is 50k. Now you have PAT as 2 lakh minus 50,000, which is 1.5 lakh. Now what is your return on equity? It is 1.5 lakh divided by 5 lakh, which is 30%. Now you have just gone from 20% to 30% return on equity just by using outside funds, which is the debt. This is what they call as trading on equity. Now, financial leverage is also called as double-edged sword. So, in the same case, now your return is more than your cost of debt. That is why you are increasing your return. But if the EBIT falls down to 80,000, then let's take the same case. Now, in the same case, let us try changing your EBIT to 80k. Let us see how it is affecting both the cases. Now, since you have 80k as EBIT, your interest is again nil. So your return on income PAT will also be 80k. Your return on income will be 80 divided by 10, 80k divided by 10 lakh, which is 8%. Now in this case, again you are earning 80k, but you are paying an interest of 50k. So your PAT is 30k, and your return on income will be 30k divided by 5 lakh, which is coming only up to 6%. So you are reducing your return because of debt. That is why it is double-edged sword. If your return on income is more than your cost of debt, then it is positive. Similarly, if your return on income is less than your cost of debt, then it is negative. Because the surplus whichever is coming is also going to the equity shareholders. If they have to face a deficit, then again it has to be borne by the equity shareholders. Now, what is this financial BEP? It is nothing but it is the level at which your EPS is 0. So, general BEP is when, plain BEP is when no profit, no loss. It is nothing but your EBIT will be 0. Now, financial BEP is when your EPS will be 0. Now, let's go to the next, which is combined leverage. This, as explained before, is nothing but the combination of both. So, CEL is directly equal to OL into FL. Now, how is OL calculated? It's contribution by EBIT. How is financial leverage calculated? It's EBIT by EBT. So, if you knock off this and this, you get contribution divided by EBT. Now, what is the degree of combined leverage? It is again nothing but DOL into DFL. DOL formula is what? Percentage change in EBIT divided by percentage change in sales into percentage change in EPS divided by percentage change in EBIT. Again, you knock off these both, you get percentage change in EPS divided by percentage change in sales. That is how much your EPS is changing because of your sales changing. That is this degree of combined leverage. Now, if your both the degree is low, then it means you have lower total risk. Now, if you have high DOL and high DFL, then it is very risky. Both the places it is risky. Now you have high DOL but a very low DFL, then it is not a good combination. But if you have your low DOL and high FLL, then it is the best combination. Now I will explain why. In both the cases, some risk is high and one risk is low. How is it a good combination and how is it a bad combination? Let us take this case first. DOL is high and DFL is low. High DOL means your fixed cost is already high and your EBIT is very unstable. Little changes in sales quantity will impact your EBIT a lot. That is what is meaning by DOL, degree of operating leverage. DFL is nothing but the financial leverage. Now, when your DFL is low, it means we don't have much debt. So that is why there is no benefit of trading on equity also. So already our business is risky. On top of it, can we again go for financial risk? No, that is why it is a bad combination. Now let us take the next combination, low DOL and high DFL. See, in this case, low DOL already means your fixed cost is low and your EBIT is also stable. You change your sales quantity, it is not affecting your EBIT so much. Whereas high DFL means you have high debt, which means you have the benefit of trading on equity. Now my core business is already stable, so I can take the risk of financial leverage and I can benefit out of it. That is why it is the best combination. That's all about this chapter. This is a very easy chapter and I will be uploading the revision video also soon. Thank you for listening.